Hello and welcome to Wyatt Investment Research's latest live options chat, the secret 40 ETFs that generate all of my profits. Thanks for joining us. I'm your host, Chris Preston, and once again I'm joined by our options analyst, Andy Crowder. As the title of today's chat suggests, Andy is here to reveal the secret 40 ETFs that help him generate consistent profits. He's also here to answer any questions you may have, and we'll get to those here shortly. For those of you who have missed Andy's previous live chats, let me start by introducing Andy. Andy is a 15-year options trading veteran who has worked for Oppenheimer on Wall Street and W.L. Gore and Associates in Flagstaff, Arizona. Andy's work has been featured in the Wall Street Journal, Seeking Alpha, and the Kirk Report, among others. And today, Andy runs our premium Options Advantage service here at Wyatt Research. Options Advantage is a real money portfolio in which Andy shows his subscribers how to generate income by using the same options strategies that he has successfully developed over the past 15 years. Andy's going to start things off here in a minute and tell you a little bit about his ETF tracking strategy. And make sure to stay tuned until the end of this live chat when Andy will give away a couple trade recommendations that he's only offering to listeners of today's chat event. We'll also tell you later how you can sign up for Andy's Options Advantage service with a special offer exclusively reserved for listeners of today's chat. So stay tuned for that. And now, before I hand things over to Andy, I want to remind you again that this is an interactive chat, so we'd like to hear from you. We welcome your questions throughout today's chat, and as I mentioned before, Andy's going to start us off with a short presentation, but feel free to chime in with questions at any time. I promise we'll get to as many of them as we can once Andy wraps up his presentation. So, without further ado, I'll go ahead and hand the floor over to Andy. Andy, take it away.
Thanks, Chris. Thanks, everybody, for making it out today. I know right before the holiday, it's hard for a lot of us to sit down for an hour and go over these types of things, but I certainly appreciate your attendance, and yeah, let's just get started. So today I wanted to go over 40 of my favorite ETFs, the ETFs that I trade in the Options Advantage portfolio exclusively, and how I choose those 40 ETFs, how I apply them in each and every trade that I use, and so on. So yeah, let's just get started. I learned early on to keep it simple. Pick a few indicators and follow them forever. And basically that is the path to wealth for any successful options trader. One of the biggest mistakes I see new traders making is that they keep digging into the toolbox for a new widget every time they see something they like. I can't tell you how many traders I know who want to follow bull flags, bear flags, candlestick patterns, channel retracements, Fibonacci retracements, the list goes on and on. They will try and teach you about their long list of indicators to make themselves look impressive, but in reality, most are horrible traders over the long term because they overwhelm themselves with a stream of the latest and greatest indicators, only to move to another indicator that happens to fit their current market perspective. Essentially, they're just data mining. I keep it extremely simple when I trade. I pick one tool and I use it for its specifically intended purpose. For me as an options trader, I'm looking to make steady, reliable gains without too much of a holding period. But having an indicator is only half the battle. You must know which products you can use effectively with the indicator, and there are only about 40 ETFs that qualify. Why? Because most underlying ETFs and stocks do not have liquid options. This is a very important concept and one that's often mistaken among many newbie options traders. If the bid-ask spread is not tight, it's just not worth trading. So again, it's very important that to realize that most underlying ETFs and stocks, for that matter, do not have liquid options. And for the Options Advantage portfolio, I've already screened my top 40 ETFs, and I actually update those on a daily basis. But I'll get to that in a bit. So the most important search criteria for finding what I call tradable options on ETFs is volume. I search for ETFs with an average volume of over 1 million shares traded because I want liquid options. Liquidity directly translates into a reasonable bid-ask spread for options. This is extremely critical. The more liquid the option, the tighter the bid-ask spread. This is extremely important because the bid-ask spread impacts the cost of using options. Wide bid-ask spreads eat into the potential profitability of your investment and contribute to what is known as slippage. A real-world example of how volume affects the bid-ask spread should help to clarify this. So let me just give you guys a really quick example as to what I'm talking about for a tight bid-ask spread and how I go about choosing which ETFs I use to trade in the Options Advantage portfolio. So, well, we can just, SPY is currently on my radar. It's the ETF for the S&P 500. Now, the easiest way to look at what's considered a tight bid-ask spread is to look at the at-the-money strike price. So, with SPY trading at roughly 140, we can look at the May 140 strike, and as you can see, it's a penny-wide bid-ask spread. 278 is the bid, 279 is the ask. So there is absolutely no advantage because that to a market maker or anyone else for that matter, if you're trading spiders. It's a highly efficient market. However, if we look at something like Move, for instance, which is the market vector's agribusiness, it's trading for roughly $52. You look at the bid-ask spread here on the call side, and it's 165 to 185, a 20-cent wide bid-ask. And that's, that's fairly significant. So you have to think, if you're buying something for or selling something, you're going to have to make up that 20 cents before you actually even start to break even. So it's always best to go with those 40 ETFs, the most liquid ETFs in the market, for reasons just as that. Because why would you want to make up 10, 15, 20, even 30% sometimes because of the bid-ask spread? Why not just trade liquid options markets? So let me get back to. So basically, in conclusion, dealing with the bid-ask spread is an inevitable part of the options arena. Focus on more liquid and actively traded contracts that have smaller bid-ask spreads rather than stocks with little to no volume and wide spreads. Once you put this lesson to work, using options as part of your investment strategies, you will save yourself many headaches and, most importantly, hard-earned money. So this slide, the next slide that you see here, this is the list of the ETFs that I actually use in the Options Advantage service and for the portfolio. As you can see here, this has some of the most liquid ETFs available in the market: the Dow, Russell, NASDAQ, S&P, respectively DIA, IWM, QQQ, and SPY, as well as several others. I've thrown in some sector ETFs, commodity ETFs, volatility, dollar, bonds, international, and leveraged ETFs as well. These are the most liquid ETFs out there currently. I continually update this list. I go over it about once a month because there's some ETFs that kind of fall off with volume, some that are added. But as you can see, what I do is I actually have an overbought, oversold reading. So this kind of couples as I've done the screen on what's the most liquid ETFs, and now I basically want to follow them and see if they've moved into an overbought or oversold situation. So in order to make options trades, I use a tool that helps me to do a few things. This tool alerts me that a profitable trade may be on the horizon, which gives me time to prepare. 2, it tells me when I should think about getting in or out of a trade. And lastly, it lets me adjust my time horizon to craft a trade that fits my needs. As I said before, I keep it very simple. I use a few basic versions of one simple tool to take advantage of sentiment and technical extremes on highly liquid ETFs. So with that being said, I would like to share with you the most powerful technical indicator that I use in my proprietary model, and that is the chart that you're looking at right now. As you can see, I give a daily reading, and whether it's overbought or oversold. But before I get into the baseline for that indicator, let me just go over a few more things. So basically, my indicator allows me to gauge the probability of a short to intermediate term reversal. It does not tell me the exact entry or exit point, but essentially it helps me to be aware the reversal is on the horizon. Knowing that a short-term top or bottom is near, I'm able to increase the probability of a potential trade. Conversely, knowing that a reversal is on the horizon, I'm able to lock in profits on a trade. Since I'm a contrarian at heart, I prefer to fade an index, whether it's overbought or oversold, when the underlying index reaches a very overbought or very oversold state. So I want to wait till it hits extremes before I place a trade. Fading just means, for those of you who don't know what fading just means to place a short-term trade in the opposite direction of the current short-term trend. And this is essentially how I make my trades in the Options Advantage service. I wait until extremes enter the market, whether they're short or intermediate term, and then I either place a short-term trade using calls or puts exclusively, or I use some form of a credit spread. But I'll get to that in a second. Of course, other factors must come into play before I decide to place a trade. But I do know that in most cases, when an index reaches an extreme state, a short-term reversal is imminent. So this is the following. The following is the baseline for my indicator. So as you can see here, a very overbought, and this is what I will provide, or I do provide my subscribers in the Options Advantage portfolio or service on a daily basis with that list of 40 ETFs. So basically, a very overbought reading is one that consists of, that reads 80 or above. Overboughts, as you can see here, greater than or equal to 70. Neutrals between 30 and 70. Oversold is less than or equal to 70. And very oversold is less than or equal to 20. So typically, I'm just looking towards the outliers. I want to look towards a very overbought or very oversold indicator. If those hit within that list of 40, then they're on my radar. Then I start to look at a few other indicators that I follow, such as the RSI2, for entry and exit points. But yeah, so I keep it extremely simple, as you can see here. So since I'm looking for extreme conditions, I focus on very overbought, again, very overbought and very oversold conditions. When an asset hits more neutral levels, that's an indication to close the trade out. This leads me to the oft-answered question, what do you think about the markets here? This is a question that I get all the time. My typical response is, honestly, I don't care, which is okay because that might be a bit harsh, but it's true. But for the most part, I really don't care about the daily news that flows in and out of the market. I'm an options trader. I trade strategies based off probabilities. I create statistical advantages based on my current market assumptions. We must realize that knowing what is going on in the news and knowing how to make money consistently are two separate things. For successful options investors, it's about your strategy, your logic, your process. It doesn't matter what you think the market is going to do tomorrow. I realize it's a difficult concept for the options newbie to understand and for a lot of traders, especially those that are moving from stocks into the options world. You see, it just doesn't pay for me to try and absorb every financial story out there. All I care about is when my indicators hit extremes. I allow probabilities, not the talking heads, to define my option strategies. And this means that the strategy enters periods of stagnation. Trade should never be forced. A forced trade is not a statistically sound trade. And this is often a problem that I find a lot of traders get into, is they just overtrade. They don't wait for that one or two indicators to hit an extreme because they're following 10, 15, 20 indicators. So they're data mining because they want to trade. Again, this means that the strategy enters periods of stagnation. Again, a forced trade is not a statistically sound trade. Again, this market apathy is a long-term approach to options trading and should be expected if you wish to bring in profits over the long term. This may be boring to many, but maybe to the aggressive crowd out there. But that doesn't concern me because I'm more interested in the profitable trades, not trying to be the short-term hero who trades every scenario out there. I'm confident in my trades, and that it essentially consists of short-term extremes that have entered the stock market, which I like to refer to as high probability trades.
All right, thanks for that, Andy. And we'll open the floor up to questions. So start sending in questions, whatever questions you may have. A few questions that are started to roll in center around the list itself.
Yeah, and I just wanted to go over, while you guys are writing in some questions, I wanted to go over a few real-world examples and show you guys how exactly I use this list in the Options Advantage service, within the portfolio. So let's see. So basically, as you can see here, I have a list of the RSI 2, 3, 5, and 14. Basically, what I do is I look at that again. I'll look at those 40 ETFs. If something comes up where it's oversold or overbought, it automatically goes onto my radar, and then I'll either look for a straight call or a put trade, or more specifically, or potentially a credit spread trade. So if we want to look at, let's see, VXX, for instance. As you can see here, it's been trading in an oversold state. So basically, there's a couple things that I could do here. So the reading over the past several weeks, it's been in an oversold state. So what I'll look for, if we go to VXX, is, for one, does it have tight bid-ask spreads? I've already done the screen. It's on the 40 ETF list, so I know that it does. And we can clarify, or we can validate that by looking at, so it's trading for roughly $17.60, $18. So let's look at the at-the-money strike in May. So you can see here there's a 3-cent bid-ask spread. So it's an extremely tight market. Look at the volume, 22 million. If we want to look at another way to look at this is if you look at the open interest on, this is another good way to look at the volume within this underlying. And you can see here the May, the 18 strikes has 3,800. The May 17 strike has, which is the first one in the money, has 6,100. So it's a very liquid option. So this allows us to create credit spreads that have very tight, tight spreads. So something that I would be looking at is, so I know that this is oversold. I know that it's trading roughly over the last several weeks, between 18 and 16. So I know my support is roughly around $16. We can verify this by looking at the chart. As you can see here, we dipped around the 15, 16, but it looks like 16 has roughly been that area of support. So let's go back to our trade screen. So as many of you know, the way that I justify after I go through my screening process, I know what the option is that I want to trade, or the underlying and the option that I want to trade. I then begin to look at the probability out of the money. For many of you that don't have this, as you can see here, we can use the delta, which is essentially the same thing. So let's look at, let's say we wanted to buy, we thought VXX was going to pop because it's been in an oversold state. So we actually want to we want to do what's known as a bull put spread. So we think the market's going to go higher. We're going to sell, let's actually bring some of these strikes out. So we'll look for, the way that I like to look at is that, let's see, probability of in the money. So the chance of, let's look at the 14 strike in VXS. And again, this is in May. So if we look at the 14 strike, which is one strike below what the support has been, and that's 15 or even 16, we can sell this 14 for 42 cents. Now I like to go, in my credit spread trades, I like to go 2 strikes wide. So I'll be selling this for 42. I'll be buying it for 12. So essentially I'll bring in a 30-cent credit. Now what I like to look for is this 14 strike. There's a 22% chance that this will will close in the money, which means it will dip below 14 by expiration, which is in, as you can see over here, 43 days. So basically I have a 78% chance of success on this particular trade if I go with it. So again, this is basically the screening process, the process that I go through for the Options Advantage or trades within the Options Advantage portfolio. I have my screen of 40 trades. Again, if I see an extremist hit and either an ETF is in overbought or oversold territory, I then go to the options chain, look at the options themselves, see what the prices are, look at the probability that an option will finish in the money. And basically, once I find that, I'll subtract that by 100, or I could just go probability of out of the money, which would be easier. As you can see here, that's 77% chance of success. And then basically, I want to formulate my my trade, or enter my trade based on my assumption and how much conviction I have on that particular, that it will finish above. If I want to be more aggressive, I could go with a 15 strike or even a 16 strike. And by doing this, I lower my probability of success. As you can see here, I have a 77% chance of success with 14. I have a 58% chance if I go closer to the at the money of 18 if I sell the 16. But the trade-off is that I'm able to bring more credit, which makes perfect sense. The more aggressive I want to be, the more risk that I'm taking, and which means I'm going to get paid more. So it's that risk-reward trade-off. I prefer to have a higher probability of success. That's something that I teach within the Options Advantage service, because I would rather have a winning trade the majority of the time than have to deal with the stress of potentially, entering into a losing trade. Yes, I can bring in more credit, but if I have a probability of success of only 58%, there's always going to be that stress point. And basically, the way that you can kind of figure out what your stress level is going to be when you enter a trade. So let's look at this. So if you take 77, and we have a 77% chance. Now look at the delta. The delta of this particular 14 strike is 15. So basically you double that, and that will give you 30. So and basically that is the chance that that VXX will actually hit 14 over the next 43 days. So basically there's a 30% chance that this trade will be under some form of stress as it moves closer towards that 14 strike. However, if you go back to where I was talking about before, let's say the 16 strike, 31%, so it's 31, double that. So there's a 62% chance that the underlying VXX will hit that short strike of 16. So again, there's several factors that lead to choosing a higher probability chance of success on these trades. So that's just one brief example. I'm going to go over a couple other trades after the questions. But as it stands out, I'd just like to take field a few of your questions because it seems like we're getting quite a few. So
yeah, a few that have been rolling in are sort of more logistical questions just about the list. How often do you publish your ETF list? And a few people have asked, how can they get a copy?
So basically, I publish this list exclusively for the Options Advantage subscribers, and I publish this on a daily basis. Basically, I've been publishing this list weekly for my subscribers, but due to the demands, most of my subscribers have wanted this on a daily basis. So starting on Monday of next week, I will be actually offering this on a daily basis to my Options Advantage subscribers.
And just so people know, we will be giving out all the information about how you can subscribe if you're not already an Options Advantage subscriber. We'll be giving that information out shortly. Few questions rolling in. Thank you, everyone, for sending them in. We'll move on to here's one. What is the best indicator for an ETF in general?
Okay, that's somewhat of a subjective question. I prefer using RSI over different time frames. Let me go back to the chart. So as you can see here, I use the RSI 2, 3, and 5. I use the 14, but I typically look at that more for an intermediate term to longer term trend. So the RSI works for me. I've been using it for well over 12, 13 years now, and I've become very comfortable with it. And like I said before, it's very subjective. I know a lot of friends that use other indicators, and they've been doing that for years. The key is that you want to pick one that works for you, and you want to stick with it, and stick with it for the long term, because you need to know how that indicator works in various types of markets. So it doesn't really matter. I mean, of course, there are ones that I think work better than others, but again, that's just my opinion. I think for my particular style of trading, RSI works best. However, that's not to say it is the best because, again, it's subjective. And the only thing that I can say is that you choose one that works for you and you stick with that and stick with it for the long term. Don't try to find 5, 10, 15 indicators because, like I said earlier in the presentation, you're just going to start data mining, which basically means if you're going to try to find an indicator that works for your assumption, and that never works. It's going to fail over the long term. It just never works. And so I say the best one is the one that works for you. Again, for me, it's the RSI 2, 3, and 5.
Okay, moving on to a few other questions. And it looks like we've gotten a few people asking if this is being recorded. Yes, this is being recorded, and it will be up on the WyattResearch.com site within a few days after this live chat. Moving on to more questions. Let's see. Here's one from Harold. Do you ever trade weekly options?
Harold, in this particular, I do trade weekly options. not in this service as it stands right now. Weekly options are fairly new for a lot of people. They, when doing credit spreads, they're a little more difficult just because of the volatility that's involved. So I tend to stay away from those. So as it stands, like I said, as it stands, we currently do not trade weekly options within the service.
Okay, and here's a question from Brian. Brian asks, do you ever use iron condors, and if so, how do you decide what strikes and time frames to use?
Yeah, that's a great question, Brian, and that's one where I can actually, I'll go through a quick example. Well, I should say quick. Hopefully it's quick. I love the iron condor strategy, and like I said, when I sell credit spreads, an iron condor is a credit spread. I trade verticals, iron condors, basically any type of credit spread, along with I have a more speculative trade that I use in the portfolio that's based off of, again, the 40 ETFs that I follow and based off of their extremes when they're hit. And in that case, I place more of a speculative trade, just using straight calls or puts. But yeah, let me show you how I actually choose an iron condor and maybe some of the confusion that a lot of people have regarding iron condors. So let's just look at something really simple. Let's go back to the spiders, SPY. As you can see here, it's trading for roughly 139.84, so let's say 140. So basically an iron condor trade is a neutral. In most cases, it's a neutral-based trade. So essentially, you're combining two vertical spreads. You're combining a bear call spread and a bull put spread. The way that I like to choose is essentially just like the VXX example that I gave. I choose it the same way. I like to choose something with a probability of success of roughly 75% or higher, preferably 80% if I can. So let's see. So if I'm trading SPY, and let's see how far out I can go. So with SPY trading again at 140, we'll start with the bear call spread first. So the probability of finishing out of the money, let's look. This one has 20%. So essentially, I have let's see. So 80% chance of success. So that gives me to 145. So I actually could go a little further out because this is May and it's 43 days. So sometimes, we can go out even a little further. So this side actually has an 85% chance of success. So what I would do is I would sell the May 146 and I would buy the May 148. So that gives me roughly a 25-cent credit on that side. And basically what that essentially says is for that particular side, that particular bear call spread, if SPY moves, it stays flat, moves lower, or it can move up to 146, and that side of the trade would be perfectly fine. Now on the other side, I'm going to choose a put, the put spread, which is the bull put spread. So essentially, I'm going to do the same thing. I'm going to look over here. Basically, the 131 is right around 80%. So that's selling for an 84% or 84 cents. And I can actually buy that for 65 cents. So roughly 19, 20 cents. So basically, for an iron condor trade, I'm bringing in 45 cents of credit. Now, this is where a lot of people get confused, is that some brokers realize that you can only lose on one side of this. The market either goes higher than 146 or goes lower than 131. If it trades within that, anywhere within that range and closes within that range at expiration in 43 days, I'm going to make a 45-cent credit. And this is where a lot of brokers are that are not option savvy. This is where they're somewhat confused. Is again, you can only lose on one side. So sometimes they require a maintenance requirement. If you use something that's 2 strikes wide, they'll require that you have 2,000. Since it's, let's say you trade 10 contracts, so that's going to be $2,000 on each side. So that would be a $4,000 maintenance requirement minus your credit, which was basically $450. So basically to make that but the problem is that if you're not using an option-savvy broker, you have that extra $2,000 that you can't lose, essentially, that's tied up. Because remember, you can only lose on one side. It's either going to go up to 146 or above 146 or below 131. So basically what you're doing is you're making 45 cents with only risking $1.55 of that, because again it's two strikes wide. So that's essentially how I look at the iron condor trades, how I place them. Again, when I place my credit spread trades, I always use probabilities to my advantage, because I want the statistics to work for me, not against me. And you have to remember, when I look at this and I'm saying that an option has an 80% chance of success to close out of the money at expiration, there's basically someone out there that's highly speculative, that is taking a gamble that something's going to move, that he essentially has a 20% chance of success on this trade. Now, I'm always going to take those trades, because why would I not want to take something with an 80% chance of success? Why would I want to take anything less? I mean, that's the great thing about using credit spreads, is I can choose, based on the risk that I want to take, I can choose my probability of success. And again, that's why I like to use roughly 75 or higher. So yeah, that's how I use iron condors, and basically that shows you also how I use vertical spreads as well.
Okay, hopefully that answers Brian's question.
Yeah, Brian, that was my short answer.
Short version. Keep sending the questions in. Thanks for those who've sent some in so far. We'll move on to another one. Let's see if we can pick out a good one here. One as good as Brian's. Let's see here. Here's a question. Is there a special ETF for a day trader? If there is some ETF that has huge moves during a single NYSE session? So basically, long story short, is there a special ETF for a day trader?
I am actually not a day trader. There's really no special ETF for day trading. This kind of goes back to, I think it was Harold's question about weekly options. That might be, so it's basically a product that you want to use, whether it's a weekly option or any type of option for that matter. Any of these can be day traded. You can day trade anything. There's no particular ETF that's better or worse regarding day trading. Again, this goes back to, if you are day trading, you want a product that's liquid. You want something that's highly efficient. And again, that's what that list is that I use. If I'm going to make a trade and I think it's going to be 1 to 3 days, I'm going to use that list. I'm always going to use that list, because I'm not going to trade anything else off of that list, because it just doesn't make sense to give a market maker a 10, 20, 30% advantage when I can trade something that's highly efficient. I mean, you have to remember that there's no rush in this. There's no rush in investing. There's no rush in trading. People, they get overwhelmed and they get very anxious. They feel like they need to be in a trade, and it turns into gambling. And that's not the goal of this service. That's not the goal, and should not be the goal of trading or investing in general. I mean, you're only as good as your long-term results. And of course, you're going to have losing periods. We've all had them. And you're going to have winning periods. But it's how you do over the long term, a year, 2, 3 years, that really shows how successful you're going to be. So, and that's why I use these 40 ETFs, because logically they make the most sense. There's no advantage to the market maker when using these. And if you're willing to wait for extremes to hit the market, if you're patient, wait for the setups and trade these extremes, you're going to have a much higher probability